A very good morning to everyone, and thanks so much for joining us again today. It's really great to see so many familiar faces of those who were able to join us in episode 1 last week here again. Last week, we focused on the determination of pay as you earn on regular income, and today we're going to be looking at pay as you earn on irregular income. We received some really great feedback from our first episode that we would like to try and incorporate into this episode. So we will just spend a few minutes at the start looking at doing a quick recap on those items. A reminder that episode 3 is where everything comes together and it will be more focused on the advanced aspects of pay as you earn. So please be sure to register your attendance if you haven't done so yet. The link to the registration link on our blog can be found in the chat box. My name is Jamie and I'm joined by Musa today, who will be co-hosting with me, as well as Brandon from our training team and Darren from our customer experience team, who will be presenting on today's topic.
Hi everyone, I'm Darren. I'm joined by Brandon, and we'll be discussing tax on irregular income. Before we start, let's go through the goal seek statement. So it's a true or false statement. So the statement is goal seek allows you to set an employee's targeted net salary and perform automated calculations to determine what their gross salary should be. We'll give you a few minutes to answer that, and then we'll go through the results together. Okay, so majority of the audience responded with true. Brandon, is that correct?
So yes, this is actually correct, and this is something that actually came up last week in the Q&A section. So it is something I would like us to spend a bit of time on today, because last week, obviously with the Q&A, that is not recorded and not everyone attended last week's session. So it would be good for us to just go over that again for those that weren't able to attend, so that they can see exactly what the goal seek functionality is.
Okay, great. So we will be taking a few minutes just to go through those great Q&A questions that were asked last week. And while we're on the goal seek feature, Brandon, we know what it is now. It gives you the ability to set a net pay amount. Can you tell us or take us through this process to enable that feature on Simple Pay?
Sure, not a problem. So you should be able to see my screen, Darren?
That's great.
Okay, perfect. All right, so to enable it, you're going to go to settings, and then you're going to go to advanced, and then under advanced, you're going to click on general. And you'll see that there is this option over here that says goal seek. And if you click that and enable it and click save, then goal seek will be enabled for your company. Now, we don't make this available by default without enabling it, because we obviously don't want to clutter the system unnecessarily. So not every company works with net figures. In practice, generally companies do work with gross figures, but sometimes there may be a situation where you are negotiating a contract with an employee and the employee says, I want to get 20,000 Rand in my bank account. I want it to be paid net. You do what you need to do and work backwards in order to work out what that gross figure is. So this is exactly what that goal seek functionality allows. And like I said, it is something that you do have to enable first.
Okay, so Brandon, so you first have to enable it for your company. And once we've enabled it for the company, how do we go about using this feature for a specific employee?
Sure. So we can go to an employee's profile. So I'm going to click on employees, and let me go to Captain Hook as an example. And you'll see that Captain Hook is currently earning a basic salary of 20,000, and he receives a net pay of 17,498 and 30 cents after UIF and PAYE have been taken into account. Now, let's say Captain Hook said, no, I would like to receive 20,000 in my bank account, so I want a take-home amount of 20,000. You can then work backwards using the goal seek functionality to get that gross figure. And the way we do that is by clicking on basic salary. And then once you click on basic salary, you'll see that there's now this new button over here that says goal seek. And if I click on that, you can then enter what is that net amount that you want them to get, and then click on calculate. And the system will then take into account what are the deductions on the payslip and then work out what that gross figure needs to be. And you'll see that that's 23,380 and 68 cents.
Okay, Brandon. So now that we know what this amount is, how do we actually push it through to the payslip? I see there's a button called use calculated value. What does that do?
It does exactly what you just said, right? So clicking on use calculated value pushes it through to the payslip, so you don't have to copy and paste or write it down and then retype it. simply clicking on that will then push it through, and you'll see that now this employee receives a net pay of 20,000 and their gross salary is 23,380.68 in order to have that net pay of 20,000.
Okay. Now, Brandon, can we actually use this goal seek feature on other payroll items?
You can. So we do also allow you to use it on commission as well as annual bonuses. So essentially, if you want into the employee to have a net pay of a particular amount, let's say 20,000, but you don't want to adjust the gross salary, instead you want to adjust something else. So let me quickly change this back to 20,000. Okay, and you'll see that if I change it back to 20,000, my net pay is 17,498. And let's say that we want commission to be the item that we're going to adjust. So I've created the commission, or I've added the commission item to the payslip. And then when I click on commission under payslip inputs, there you'll see there's the goal seek functionality. So I'm going to click on that. I'm going to tell the system that we want this employee to have a net salary of 20,000, and the system will then calculate what should that commission be in order for them to have the net salary of 20,000. So the commission in this case is 3380.68. And if I push that through to the payslip, you'll see, there we go. I've now got my commission added so that I have a net pay of 20,000.
Well, Brandon, that's a really good feature. Lastly, before we move on with the session, let's say we do a goal seek on the basic salary, but at a later stage you want to add other payroll items. Will the system automatically adjust the goal seek value to account for the new items added to the employee's payslip? Let's say a deduction that affects the net pay.
So no, it won't. And I think as a payroll administrator, it'd be pretty disturbing for you if figures were just changing automatically on their own and payslips were just changing, because it means, okay, I've processed this payslip and now while I wasn't looking, something changed. We obviously want to give you control over your payslips. So anytime that you do add anything to a payslip, you do then have to go and reperform the goal seek function to tell the system that this is what you want it to do.
Okay, that makes a lot of sense. Now, last week we also discussed the cumulative tax method, which we determine is the method used by SimplePay to calculate pay as you earn on irregular income. And that method is used to calculate pay as you earn on irregular income as well. So just keep that in mind as we go through this session. Brandon, you took us through the calculation of the annual equivalent last week, right? And we dealt with the employee that was paid a fixed salary that had fluctuating income. Now, what happens in the case where an employee gets paid on an hourly basis? Does this affect how the tax is calculated?
Good question. I think it is something that people do get a little bit confused with. And what we need to distinguish between is how an employee gets paid. So in other words, if they get paid a fixed salary or if they get paid hourly, what is their pay frequency? So do they get paid weekly, monthly, twice a month, every 2 weeks? And then the employee classification. Now, when it comes to the first one, which is your weekly paid or fixed salary, that does not impact the calculation of the annual equivalent or how PAYE gets calculated. Only the actual pay frequency or the employee classification will actually impact the PAYE. As an example, if I go to my employee over here, and let me have a look at a monthly paid employee first. So I'm going to look at Periwinkle. You'll see that this employee earns, and they get paid hourly, and they get 50 Rand per hour. And in this month of March, they worked 172 hours. So the total that they earned for the month is 8,600. And then with your public holiday, that's 9,000. And if we look at the tax trace, you'll see that what we've done is we've taken the 9,000 and we've divided by the 1 month worked and then multiplied by 12 to work out my annual equivalent of 108,000. So the fact that this employee was hourly paid is almost irrelevant to the calculation of the annual equivalent. You'll see that we're still doing the same thing. We're taking the total that was earned for the period and then multiplying it by 12 to get the annual equivalent. So like I said, irrelevant whether it was hourly paid or whether it was a fixed amount. So we take the total.
Okay. Now you mentioned that the pay frequency and the classification of the employee could affect the tax calculation. Let's start with the pay frequency. How does this impact the tax calculation?
Okay, so we can look at, I've got a weekly paid employee over here, so Tiger Lily. And again, you'll see that with Tiger Lily, they are paid an hourly rate, but they could be paid a fixed amount. And again, we're going to multiply the hourly rate by the normal hours to get the total amount. And when we are calculating the annual equivalent, again, you'll see that we are using that fixed amount again. The only difference is that we multiplying it by 52 when we annualize it because it is a weekly paid employee. So that's the only way that the annual equivalent gets impacted with the pay frequency, is that instead of using 12 as the pay period, it would use 52 or 26, or so depending on what the pay frequency is, or 24.
Okay, and that feeds off from what we discussed last week, where we said that the tax calculation is based on the number of payroll periods within the tax year.
Exactly.
Okay, so let's move on to the classification. This one is a bit more daunting. We had a lot of questions based on contractors. Should they be paying pay-as-you-earn, or is pay-as-you-earn being calculated differently for contract workers?
So I know this is something that came up quite a lot in the chat last week, so I'm glad we are addressing it. Now, in practice, people tend to use the idea of contractors, they seem to use it quite interchangeably or in many different contexts, whereas SARS actually distinguishes between different types of contractors. So when you're talking about contractors, you could be referring to seasonal workers, so someone who's on a short-term contract. You could be referring to an independent contractor. You could be referring to someone who's on non-standard employment. So SARS actually separates them all and has different treatments for each of them. Now, you'll remember that last week we went to this employer's guide, so the guide for employers in respect of employees tax for the 2023 tax year.
Yes.
And in this guide, you'll see that there's a whole section over here, section 13, that talks about the classification of employees, and it breaks it down quite nicely for you. However, there is also another SARS document over here, which gives you a summary. So over here, you'll see that, for example, with independent contractors, we're going to be applying the normal tax tables. When it comes to seasonal workers, so workers that are on a fixed term contract, again, we're going to be applying the normal tax tables. And then when it comes to non-standard employees, we're going to be deducting it at a flat rate of 25% rather than using the tables. So it breaks it down quite nicely in this document for you. But like I said, you can go and read more about it in that SARS document.
Okay, and I see that the only employee or the only classification that really affects the employee from a tax perspective is that employee that's on or deemed to be a non-standard employee. How does Simple Pay know exactly when an employee is a non-standard employee?
So let's actually go and have a look at what the legislation says, and then I'll show you how we do it on Simple Pay.
Okay.
I'm not going to dive too deep into this, but you'll see in section 13.4, they talk about standard employment. And here they talk about what is non-standard employment. And they say that non-standard employment is any employment which cannot be classified under standard or deemed standard employment, or it's workers who are employed on a daily basis and are paid daily. And when we deal with this on Simple Pay, you'll see that there's a section. So let me quickly find an employee. So I've got, no, not Mary. Let me go back, sorry. Give me 2 seconds, Gary. So you'll see that Gary is earning 10,000 Rand and he's been taxed at 25% because the PAYE is 2,500. And the reason that he's been taxed at 25% is because we've actually set up his classification, and you'll do that in this section over here to tell the system that he is a non-standard employee. So we actually determine it for you. You just have to go through the questions and answer it, and we will then tell you whether that employee is a standard or non-standard employee.
Okay. And when it comes to independent contractors, Brandon, are all independent contractors added onto your payroll system and taxed according to the tax tables?
I'm glad you actually brought that up. So the answer is no. We do need to distinguish between true independent contractors and then independent contractors who are deemed to be employees. Now, when it comes to true independent contractors, these contractors should not be on payroll whatsoever, right? Remember, with a true independent contractor, it's someone who's working for themselves potentially. They are coming to provide a service at your business, and they will issue you with an invoice. You will then pay that invoice, and then they will deal with the tax in their own capacity. So if they're a company, they'll pay company's tax, or they'll pay provisional tax. So they deal with that on their own. However, there are certain instances where an independent contractor could be considered or deemed to be an employee for PAYE purposes. And there's a whole bunch of rules around this, but generally it has to do with who supervises them, as well as where do they perform the majority of their business. And there's actually a whole SARS document, and I won't go into too much depth of this again because it is 29 pages, but there is this SARS document that we can make available to everyone. And this helps you determine whether someone is an independent contractor, or a true independent contractor, or one that needs to be added to payroll. And in particular, something I want to point out is in Annexure B, which is on page 21, there's a whole flow diagram that you can go through to determine whether someone should be subject to employees tax or not subject to employees tax. So you can go through this flow diagram, answer the yes/no questions, and then it will help you determine whether they are a true independent contractor or one that needs to be added to payroll.
Okay. Now, Brandon, when let's say we have an independent contractor deemed to be an employee and we add him onto the system, what's the purpose? Because I saw on the classification page there was an independent tick box. What's the purpose of ticking that box if the employee will be taxed as a normal employee?
Good question. So let me actually find someone who is an independent contractor. So you'll see Mary here is an independent contractor. And there's two reasons why you're going to, sorry, let me actually just show you that she is, right? So I've clicked independent contractor. And there's two purposes of why you want to indicate that they are an independent contractor that's deemed to be an employee. The first reason is that we want to record, or we need to record, their income on a particular SARS code. So on their tax certificates, we have to report it to SARS under the independent contractor's income code. And then the other reason is that you'll see that there's no UIF deducted for independent contractors. So you'll see that for this employee, Mary, she only has PAYE deducted and not UIF.
Okay, wow, I didn't know that. Brandon, thanks so much for clearing all that up.
No problem.
We're going to proceed now to the tax, or the discussion on irregular income and how tax is calculated on that. Before we dive into that section, let's start with a poll. So the poll question should appear on your screen any moment soon.
Sure.
And the poll question is, which one of the following may be considered an irregular income item? We're going to give you a few minutes to submit your answers, and then we'll go through it together. A large majority of the audience responded with the ones of commission being a irregular income item, with only 23% saying that it's a 13-check annual bonus and 4% saying it's a basic salary. Brandon, what is deemed to be an irregular income item on this list?
Wow, so that's quite a mixed response. And I think let's go and have a look at the SARS documentation. So let's go back to this employer's guide, and you'll see that there's a section 14.8, which talks about annual payments. Now, SARS refers to annual payments or bonuses. We refer to it as irregular income because technically it could be paid more frequently than annually. Okay. But let's have a look at what the definition of that is. So it says an annual payment is an amount of net remuneration that is in accordance with the employee's conditions of service or the employer's practice, paid in a lump sum to the employee, or that is calculated without reference to a period. So essentially what this is saying is, if you are paid on a monthly basis and you're receiving a basic salary, that basic salary that you receive is related to that payslip. However, when you're receiving something like an annual bonus, that annual bonus is not related to one particular period. It's not related to one particular payslip or that particular payslip that the bonus is on. So that is an example of an irregular payment, so an annual bonus. So the correct answer there was annual bonus. But you'll see that there are a few other examples that SARS does list here. So incentive bonuses, leave paid out on resignation, encashment of leave, merit awards, etc.
Brandon, we saw a large amount of responses were geared towards the once of commission. Why is once of commission not deemed to be a irregular income item?
So firstly, that commission can actually, it needs to be reported on a separate SARS code. So that's the one thing, we do include commission. And generally commission, when you talk about once-off commission, do you talk about ad hoc commission, or are you referring to a commission that's received once and never again? Like,
well, generally paid once or twice in a tax year, you know. Look, based on what I'm reading in the employer guide, it seems like the commission could be argued that it's geared towards a specific period because that commission was earned in a specific period. So I'm assuming that would be the reason. Yeah.
Yeah, I agree. And like I said, you know, when we talk about once-off commission, often those we're referring to just ad hoc commissions, but it's still something that's going to be occurring on a regular basis.
Okay. So it is taxed on a regular basis, just to confirm. Okay. So Brandon, other than when the irregular income is paid to the employer, the frequency that's paid, what else differentiates irregular income compared to regular income, especially when you're dealing with the cumulative tax method?
So how we calculate the actual tax, that differs completely. And yeah, in this guide, again, it tells you how you're going to be dealing with that tax calculation. But I'm just going to summarize it for you. Essentially, what the difference is that we're not going to be annualizing the irregular income. Remember when last week we spoke about, okay, when we calculate in PAYE, we're going to determine an annual equivalent. So we're going to take your year-to-date earnings, we're going to divide it by the number of periods to work out the average per period, and then we're then going to multiply it by the number of periods in a year, which in our case was multiplying it by 12 for monthly paid employee. Now, if you're receiving a once-off bonus, and that bonus is, let's say, 100,000 Rand, it doesn't make sense to annualize that or to work out an annual equivalent and multiply it by 12. If you take that 100,000 and multiply it by 12, you're going to get 1.2 million, which is going to be way more than what your actual projected income is for the year. So that is the main difference, is that it's going to be treated separately in the calculation and not included in the annual equivalent calculation.
So we don't annualize irregular income at all. We just take the amount that's paid out to the employee as is and include that in the tax calculation.
Yes, correct.
Okay. Brandon, now that we know what irregular income is and what differentiates what the difference is between regular income and irregular income, can you provide us with an example or scenario where we actually calculate the tax on irregular income?
Sure, not a problem. Let's go back to our employee from last week. I think that's a good starting point. So our employee last week was Peter Pan, and if you can recall, we said that Peter Pan earned 20,000 in March, and then he earned 25,000 Rand as a basic salary in April. So he had fluctuating income. And I'm going to add, I'm going to add the bonus. Remember that the bonus is under payslip inputs because it's not something that is a regular input. So I'm adding a bonus, and let's make that bonus 100,000. Let's go big. And let's go and have a look at what happens with the calculation. So once again, SimplePay does show you the calculation in the tax trace, but I'm going to do it manually in the spreadsheet again, just to show you how it works. Okay. So we'll start off by doing exactly what we did in the previous episode. So we'll start off by doing the regular taxable income calculation. So we're taking our year-to-date income of 45,000. We are dividing it by 2 to get the average per period or the average per month, and then multiplying it by 12 to get my annual equivalent. Once we have my annual equivalent, we're then going to work out the tax on the annual equivalent. And once we have the tax on the annual equivalent, we're then going to de-annualize that to work out the year-to-date tax. Now, remember last week we then said, okay, after we do this, we're going to subtract the tax that we paid for March so that we know how much we have to pay for April. Now, what I've done over here is you'll see that because there's now a further step with adding the irregular taxable income calculation, because there is a further step, we're going to subtract the PAYE already paid right at the end. So we're not going to do it in this section over here like we did last week. we've moved it further down, and then we're going to first work out what is the tax on the irregular taxable income. All right, shall we dive into that?
Yeah, let's go ahead.
Okay, so now that we know what the year-to-date tax amount is for the regular income, we can look at the irregular taxable income. We said that the annual equivalent on the regular income is 270,000. So that comes from the top of a year. And now we want to determine what is the total projected income for the year. Now, the total projected income for the year is going to be your annual equivalent plus your irregular income, which in this case is 100,000. And that gives me a total projected annual income of 370,000.
Okay.
Once we have the 370,000 as the total projected annual income, we're then going to work out what is the tax that we would pay on the total projected annual income. And this we're going to do in the same way that we did it last week. We're going to go to the tax tables that SARS gives you, and we're looking at the 2023 tax year. And again, we're going to look, where does that taxable income fall into which tax bracket? So 370,000 falls into this bracket over here. All right. So we'll be paying this amount of tax for the year. So 73,726 is your base amount or your lump sum amount. 73,726. And then we need to work out what is the amount that is above 353,100, and then work out 31% of that. So to work out the amount above 353,100, we're going to take this 370,000 minus that 353,100 and then multiply it by 31%. Sorry, I know I'm jumping around a lot, so I hope everyone's following. All right, yeah. So equals 370,000, let me put that in brackets, 370,000 minus 353,100, and then we're going to multiply that by 31%. And you'll work out then that the variable amount is 5239, and when we add the two together, that gives us the total tax on that total income, which is 78,965 before factoring in any rebates.
Okay, and just to go over it again, because I noted that we're basically using two tax brackets to calculate the tax liability in this case. So you calculate the tax or the annual equivalent, you determine the tax or the total tax liability based on that annual equivalent according to the tax tables, and then you add the bonus or the irregular income, and that gives us the total taxable income for the year, which we then apply to the tax tables again. In this case, the employee was taxed for the annual equivalent on the second tax bracket, and then on the third tax bracket for the total tax income, which included taxable income, which included the irregular income. Now,
yeah, just remember that this 100,000, right? It's quite a large amount, so it is pushing this total projected income for the year into a higher tax bracket, and that's why we've moved from that second tax bracket to the third tax bracket.
Okay, and that also explains why we see such a big difference between the tax on the annual equivalent or the regular income versus compared to the total tax on both the irregular and the regular income. Now, Brandon, once we've determined the tax on the annual equivalent and the tax or the total taxable income, which includes the regular income as well, how do we differentiate what the irregular income tax is if we want to separate it?
So remember, what we're trying to do here is we're trying to determine what is the tax on the irregular income, and
okay.
We've worked out what is the tax on the total income, and then we've worked out what is the tax on the annual equivalent, or in other words, regular income. So if we know the tax on the total income and we know the tax on the regular income, the difference between the two is going to give you your tax on your irregular income. And that's essentially what we're doing in step number 3 over here, is we're taking that tax on the total income of 78,965. We're subtracting the tax on the regular income of 52,120, which comes from the top over here. And the difference between those two will then give us the tax on the irregular income, or in this case, the tax on the bonus, which is 26,845.
Okay, so now that we know the tax on the irregular income, we've already calculated the tax due on the regular income. Do we have to prorate the tax on the irregular income as well before we calculate the final tax amount?
No, we don't, because remember that irregular income is actually received in the month. Remember when the reason why we de-annualize or prorated the tax with the annual equivalent is because that annual equivalent was a projected amount for the year, but you hadn't earned the 270,000, right? So that's why we had to de-annualize it in order to determine a year-to-date PAYE or year-to-date tax. Whereas with the irregular income, that full 100,000 is actually received in this month. So that tax on your irregular income, that 26,845, is going to be paid in the current month.
Okay, so when it comes to irregular income, you pay in the tax in the month, or the full tax liability in the month that it's actually earned. That makes a lot of sense. Okay, so Brandon, we understand what the tax on the irregular income is and the regular income. Take us to the next step in calculating the final tax liability for the current payroll period.
Okay, sure. So remember that last week we said that we're going to determine what is the year-to-date tax. So in other words, what is the PAYE that they should have paid for March and April? So now we know that's the amount that they should have paid for March and April, and this is the amount, and that's for regular income, and this is the amount that we have for irregular income. So we can simply add the two together to determine what is the total PAYE that I should have paid for March and April. And once we have the total PAYE for March and April, we simply subtract the PAYE already paid in March, and that gives us what is left to pay in April.
Okay. Well, that was easier than I expected. Brandon, do you mind showing us how this looks on the tax tray so we can just visualize if it looks exactly the same way we've seen it on the workbook that we've just gone through?
Sure, not a problem. So you'll see that in the tax trace, we've got our annual equivalent over there of 270,000, and the annual equivalent, we then work out what is the tax on that annual equivalent for the year. You'll then see that we've also worked out the total projected income for the year, so that 370,000 that we spoke about at the top of a year, so 370,000. We then worked out what is the total tax on that total income, and we got 62,539. And then we subtracted the two in order to get what is my tax for the irregular income, and that we got 26,844.69. Okay, so you'll see that mine is rounded off, but 26,845. So I probably had a setting here which rounded off, so apologies for that. But you'll see it's very close. It's only a couple of cents off, right? So it's where we 26,844.69, so it's 31 cents off. And then once we've got that amount, we then add that irregular income amount to the de-annualized PAYE. And once we've got that figure, we then subtract the tax already paid, and that gives us the total for the current payslip of 3469 and 28 cents. And my one is 3469 and 59 cents. So again, I just made a rounding, obviously formatted this to round it off. And so there's a slight rounding difference over here.
Okay, no problem, Brandon. Now, we determined that the tax on the irregular income is paid in full in the current payroll period that it's earned. Does that mean that in the next payroll period, if the employee doesn't earn any more irregular income, their taxes should come down to where it usually is when the employees are only earning the regular income?
Yes, exactly, right. So remember that this is a cumulative calculation. So we are going to recalculate the PAYE on every payslip. So we're going to do the full calculation in the background for you. And then we're going to say, okay, you've already paid this large sum of PAYE, so this is the difference that you have to pay. And that's likely to be a much lower amount because, of course, you have paid 3469 in the previous period.
Okay. Thanks so much, Brandon. That was a really great explanation on tax on irregular income. We're going to move on to a scenario, but before we do that, we're going to, another poll will appear on your screen, and I'll go through the poll question as soon as it pops up.
Sure.
Okay, so the poll question is, would setting up a savings item on SimplePay allow you to spread the pay-as-you-earn of the irregular income over the year to ensure your employee receives their 13-check annual bonus in full without having to pay pay-as-you-earn in the month they receive the bonus? So think about this. We'll give you a few minutes just to answer the question, and then we'll go through the results. So 77% responded with yes, with only 23% saying no. Brandon, what is the correct answer to this question?
So upon reading this, I think this could actually be interpreted both ways. So my argument would be is that everybody is right. So well done to everybody. You all got the correct answer in my eyes, and it depends on how you interpret this. So Simple Pay, we currently don't have a functionality to spread the tax over a full year, so the PAYE over a year. What we do recommend that you use is that you use the savings item to save up the PAYE for the employee and then offset that savings against the PAYE on the bonus in the month that you are paying the bonus. So that is the method that we recommend. Of course, if we get a lot of feedback from customers saying that you would like this functionality to be able to spread it over the year, then we can look into that and seriously investigate that a bit further. But for now, we prefer the savings method because we know then that the employer is in control of that amount, right? Remember, if you've paid that amount over to SARS, that PAYE that you've spread over the year, and now at the end of the year, you decide, actually, we're not paying bonuses, or the bonuses are not going to be what they are because life is unpredictable. We all know about the pandemic that happened very unpredictably. And now what happens is that money is sitting with SARS and you can't get it back. The only way for the employee to get it back is then on assessment. Whereas if you're using the savings function, that control is in your hands as the employer, which means that if you decide not to pay a bonus, you can simply pay out those savings to the employee and you don't have to worry about trying to get that back from SARS.
Also, just to add on to that, I mean, thinking about from a employee view, the employer could invest that savings to then incur interest. We're paying it to SARS, doesn't do that. Okay, Brandon, would you mind taking us through an example where you actually show us how the employer or the savings item is used to offset the tax on the annual bonus or irregular income?
Sure, not a problem. All right, so I'm going to go back to Peter Pan, and let's say that this bonus, so we're just going to ignore this bonus. Let's remove it. And let's say that we know that Peter Pan is going to be getting a bonus at the end of the year, and let's say that is a 50,000 Rand bonus. And we've determined that we would like this employee to save 2,000 Rand. Do remember that you do need to get buy-in from your employee before you just start deducting savings from their net salary.
Yeah.
So I'm going to add the savings option. So that is under regular items, and there you'll see savings over there. And we've determined that we want this employee to save 2,000 Rand per month. So I'm going to finalize the payslips all the way until December, and you'll see that the closing balance as I go along is increasing by 2,000 Rand. So every single month, 2,000 is being deducted from their net salary. So they're receiving 2,000 Rand less, but you as the company then have 12,000 or 14,000 or whatever it might be by the end of the year of this employees.
Yeah.
Okay, and November, you'll see the closing balance was 16,000 in November. And now let's say in December, we're going to go and add that annual bonus of 50,000. So what you'll see is that we've added the bonus, and because we've added the annual bonus, the PAYE amount has obviously gone up quite significantly. So it's gone up to 16,624. And now what we can do is we can actually go and pay out those savings. So I click on that savings item just to show you again. So I'm going to click on the savings item under payslip inputs, and I'm going to pay out the balance on the current payslip. Now you'll see that the payout amount is 16,000, or the balance is 16,000, but when we were looking at it on the screen, it said 18,000. Now the reason for that is it was 16,000 at the end of November, and we would have deducted another 2,000 in December, but because we're paying out the savings instead in December, it doesn't make sense to deduct and then pay out, so we'll simply not deduct the 2,000 for December. And when we pay that out on the current payslip, you'll see that that amount of savings is offsetting the PAYE that we've calculated, and as a result, the employee is getting almost very close to the actual income, gross income that they've earned. So their gross income was 75,000, and the net pay amount is 74,198.30. So they are essentially only losing R1.70 of their gross amount because we have the savings to offset that PAYE.
Okay, so the employer loan does the same thing as spreading the tax and paying it over to SARS in advance, but only better because the employer withholds that amount, doesn't pay it over to SARS, pays it out to the employer when the irregular income tax becomes due, and yeah, no refund is needed if there was a overpayment made to SARS. That's very good. Thanks so much, Brandon.
Employer loan, but I think you mean savings.
Sorry, savings. That's get confused between the two. Savings item. That's correct. So thank you for correcting me, Brandon.
No problem.
Is there anything you want to add before we hand over to Jamie, Brandon?
I think we've covered the gist of it. Yeah, I think I'm good.
Wonderful. Thank you so much to everyone for joining the session.